All right, now we're going to talk about long-term investing. So, long-term investing is, when we're talking about it, we can be talking about investing with very large time horizons. This could be years to decades. And we're going to review some of the time horizons of various different positions here. You see position trading here depicted with the same price movement, but just broken down into the position trader seeks to buy and hold the entirety of this movement up before it starts to reverse on a larger scale. And long-term investment is essentially the same, just maybe a longer time horizon than within 1 year. They might hold it for even longer than a year. They may use fundamental analysis to look at the general health of the company to determine this. They also might use technical analysis to find entry. Swing trading, in contrast, seeks to capitalize on the large pivots made in the trade. So you might see a 4% rise up to this point, capitalize on that, maybe get out before this decline, and then ride up to 9%. Kind of trying to reduce your exposure to some of these downturns, and you might even do a short or a put for some of them if you're a swing trader to, in the least, protect your positions. And then so that's position versus swing trading right there. Day trading, all the trading takes place within the course of a day, and all positions are closed out within that day. So the time horizon is minutes to hours there. And then high frequency trading is something that you would do algorithmically if you were interested in it, but not so much by hand. So components to long-term investing. The earlier you invest, the better. Just in that the markets overall generally go up over time, and so the earlier you get in your investment, the longer time horizon you have to make gains. Dollar cost averaging, we've gone over that in previous lectures, and that's a helpful technique for getting in and get out of positions. You want to focus on a majority of the move, and you want to have diversification amongst your assets and the risks that you take. Rebalancing is another strategy similar to dollar cost averaging. Rebalancing is where, let's say you have bought Amazon a long time ago, and obviously it made a tremendous amount of profit compared to some of your other investments. And so rebalancing would basically start to sell some of that Amazon stock as it's going up and becoming a larger portion of your portfolio comparatively, and it keeps Amazon within that designated diversification box. And so you would prevent tech stocks from dominating your portfolio, even though they're giving larger amounts of returns. And that can pay off when they have corrections later and you started to sell as they went up, and then you started to buy into other assets as they were going down potentially. So another aspect is tax strategy. So you want to think about Roth versus traditional IRAs. Roth basically is where you pay your tax ahead of time, and when you withdraw those funds, you would then not have to be taxed on them. So Roth is good because basically you're not being taxed on the gains that your retirement account makes. So you're just taxed on what you put into it. Traditional IRA is the opposite. You're not taxed. It's deducted from your taxes the years that you put it into your IRA, but it is taxed upon withdrawal. And so why would you choose one versus the other? You would consider what sort of tax brackets you might be in when you are, retiring is one aspect, and then also the taxes being made to the gains is another thing that you'd want to consider. So and this is just an overview, so you definitely want to do more research on both of those. So next slide. There we go. So the mindset that you want to have is that you want to diversify your your holdings. You don't just try to weigh in on a couple of outperformers. Let's say Tesla's doing very well this year. You don't just want to put in a huge amount in Tesla necessarily. You want to diversify. If you want cash flow, considering you have a long time horizon, you can enter some stocks with dividends and choose either to reinvest them or to pull them out and have cash flow. You do want to consider, though, that if this isn't an IRA, a Roth IRA, you can't withdraw those dividends, and they could just add to your cash holdings within your IRA. But also, there's different tax situations with dividends you want to consider. Generally, though, the mindset you want to have is set it and then forget it. So focus on long-term fundamentals instead of day trading. So you see stocks going up and down within a given week or month. If you're long-term holding, you don't pay attention to all those movements. They can cause you to sell your position or buy more based on small movements. So that's not what you want. Diversification among assets, and this is a picture here of just different asset classes and their returns over different years. And so this is very interesting to look at, and that you can see that there are years that assets that you might say typically perform very well don't perform very well. You look at 2008, the S&P was down 36%, and gold was only like 4.9, while 2010 gold was like nearly 30% up, while the S&P was even behind that. And so you just want to kind of consider the fact that various assets are going to perform well at different times, and that's what you want to have, diversification, so that you can average out instead of just trying to chase the market around. So some styles of investing are growth. Growth investing is when you focus on the potential growth and momentum of a stock, and so this might be in a new tech startup that has a technology that's incredible, or the fact that a certain company that already exists is seeing a ton of adoption, and that's capitalizing the momentum. Value, you focus on the style of value, you focus on assets with high value and a low price. So you might even be investing in more typical stable assets, such as like a utility ETF or something. Like if you saw that utilities were pretty undervalued, you might invest in them. It's not really a growth asset. You're not going to see those become top performers for the year, but it's value focus. Stability, you look at stocks versus bonds. Stocks have a little bit less stability than bonds, but bonds have lower returns. And then new technology, as we mentioned earlier, with growth focus. And just thinking about the technology adoption curves, there is that there are a few innovators in the beginning, a few early adopters, and then the early majority, followed by the late majority and the laggards. And this is the saturation of the market share in that time. So you might want to be investing in some things that have high growth potential, and put a small part of your portfolio in there, and that they can see huge returns over time. So that's one thing to consider. So high time frame analytics. These are some approaches, ways of looking at the market. You can use them to trade any time frame, but they are pretty good at looking at the high time frame. And these are Elliott Wave and Wyckoff. There are many more approaches. These are just two of my favorite. Wyckoff analysis looks at the phases that a stock or something will go through, essentially, of accumulating, where large players in the market accumulate, shares of it, and then they begin to move it up. And then distribution, when they are eventually ready to sell off theirs and distribute it on the market. And these large investment players, they can't just day trade back and forth with their investments, in that it's just high cost for them, and they are pushing so much that they won't get good prices unless they use a strategy of accumulation and distribution. And so, yeah, as a long-term investor, this can be beneficial to you in that you can follow similar time horizons as well. Elliott wave can be good for long and high time frames in terms of it's talking about trending movements as impulsive movements up, and gives a good structure for that. And then also helps you recognize when corrective movements have started, which can be good for exiting positions. So yeah, an example here of potential impulsive movement tracked on the trade desk here would be that you had a 1, 2, 3, 4, 5 for the impulsive movement, and then you had corrective movement down in 3 waves, and then starting another impulsive move. And so, yeah, as an investor, and this is a bit more of a swing, I guess, here, because it's within 1 year, but you could be tracking the wave movements and recognize that, oh, we've had a pretty good 5-wave structure that could be completed around now, and so you could start dollar cost average out of your position here. You're tracking the corrective movement down, and you see this 3-wave structure completed. And so once you start to see strength re-enter, you could re-enter that position. And that's somewhat of a swing trading approach. Long-term investing, but like at least it's a decent example there of. And then another approach you can have is using trend lines, is to stay in the stock as long as it's holding to certain trend lines. And so you see here, this is oh man, I can't remember which stock it was, but it was a pretty high time frame viewpoint in which the stock was moving up based on those trend lines. So you could say, yeah, I'm going to start to after holding this for a number of years, you could look at averaging out as it gets close to the trend line again. And then you could, if in terms of recognizing when the market is not so favorable anymore, you could look at when the break of that lower trend line happens to exit. Another approach is to use highs and lows. So you see here that we're setting high, low, high, low, high, low, but this low goes below the previous low, so it's a lower low. So that's a signal that something has changed. And then you would look to exit on a higher low. So this high was lower than the previous high. And oh yeah, no, I'm sorry. The secondary high, the shoulder, is lower than this high. So it's all good until you set a lower high here, and then you would look to exit. So yeah, so you got alerted to the fact that there was a change of behavior here, but then you exited off of the sort of lower time frame, higher low, or lower high. So that would be your exit. And then for your entrance again, you would look for a higher low, and then a higher high. And so here, at this point, we set a higher high, and then here we set a higher low. So you could enter off of strength at that point. So yeah, that's examples of using highs and lows. You can use Fibonacci's as well. You can take the whole movement, and that would be, so it would be this point to this point, and then you would basically look to see a reaction on these major areas here: the 236, the 382, the 618, and yeah, so Fibonacci retraces can be helpful for figuring out targets. So, in closing, long-term investment, it's important to have a diversified investment allocation, and this reduces your risk by being diversified. The long-term investment also reduces the amount of time that you spend constantly checking your investments, reduces your taxes and your fees that you would pay to your brokerage. And another thing in closing is that education is key with long-term investing. Is just to to really analyze and look at the things that you would consider investing in, and learn just how to analyze and manage that investment. So, yeah, thanks, guys.